And while that's going, I can tell you a little bit more about me. So I grew up on a sheep beef property. I studied agriculture at Dookie. I started working at Landcare, did a bit of facilitation there, and then started working for Agriculture Victoria as a whole farm planning officer. So wild farm planning is a really fantastic program, and I'd really recommend everyone develop a farm plan. The farm business component was missing. So while it was great to talk about, you know, all your natural resources, the farm business element was missing. And so when I took up the role as young farmer coordinator, I had the opportunity to deliver or organise the delivery of young farmer business boot camps. And so they have really helped people get a handle on their farm business skills, budgeting and so forth. And then I guess building on that, or something a little bit different, is what we're doing today, is that you know, this farm finance getting prepared workshop. So a shorter, sharper session with some of the other aspects. So so I know from personal experience that it can be really hard when you're trying to get started in ag. My husband and I fell in love with a little property. We loved it, and we just sort of assumed that we just swan on into the bank and they'd just happily loan us the money and off we'd go. It wasn't quite like that. They didn't probably love the little property as much as we did, and it took us a lot longer to, you know, find out other ways of purchasing that property, which we did do in the end, but it would have probably been a lot easier if we had have had something like this to come along to, just to, you know, get ourselves a bit more organised. Yeah, so before we went searching in for that beautiful property, maybe just take a step back and figure out what we need to have in order before we go. So so today Jane will hopefully help us out with a bit more around that. So look, I'm seeing lots of great messages in the chat, who we are, where we're from. We've had a lot of people join from a lot of different areas, so it's a great diverse group. So just before we kick on and really get to hear from Sam and Jane, which I'm sure they're itching to do, I'm just going to start a quick poll. And really want to know, just at the start of this today, how are you feeling? Are you, like, confidence-wise? So there's two questions. How confident are you that you have the required knowledge to set achievable goals and make just good decisions around borrowing money? And the second part is, how confident do you currently feel about applying for rural finance? So we're hoping that at the end of today, when we ask this again, that these answers have changed. So that's going well. So I'll just leave that ticking along in the background there for the moment, and I'll just go along. And now I'm just going to hand over to Sam and then to Jane, who will introduce themselves and then kick off the session with that overall, you know, story about farm finance. So thanks very much, guys.
No worries, thanks, Sarah. Yeah, as Sarah mentioned, my name's Sam Henty. I work as a farm business economist with Agriculture Victoria, based at the Bendigo office. Before Agriculture Victoria, I worked for University of Melbourne and the CSIRO. I have a degree in ag science, a master's degree in agricultural economics, and I grew up on a dairy farm up in northern Victoria. And I'll be here just to basically help facilitate the discussion with Jane. So yeah, that's me.
Okay, thanks, Sam. I might take on from there. So Jane Foster, I'm a senior agribusiness consultant with ORM. We're a firm based in Bendigo, Victoria, and we do deal with predominantly cropping and mixed farming enterprises. I can see from all the chats coming through that we've got a great cross section out there from all across, there's interstate all across Victoria and across lots of different industries. So it'll be really great to have that cross representation today. I am also from an ag science background, so did the degree at University of Melbourne there quite some years ago. And after that, I went into working in banking and finance, specifically in the agribusiness or agriculture side of the NAB. So I spent quite a lot of years there looking at farm finance and financing commercial in general. And I've since left there and work in consulting, which is also very interesting because it's a bit more direct involvement with clients. And I have also studied a master's in business. So I really find this side of business really fascinating and love working in it. So I'm happy to be here with you all today. Thanks, Sam. I think we're going to move through into our next section. Or...
Yeah, get into it.
No worries. So Jane, could you just tell us a few reasons why a farm business borrows money?
Yeah, so I guess if I look back on my experience, some of the primary reasons are obviously when they're looking at expansion opportunities. So sometimes that might be additional land, but it can also be when they're diversifying. So maybe bringing in other types of enterprises into what was an established farm mix. They also, sometimes some businesses are looking at purchasing water and they'll borrow to do that. Another large area that we used to deal with was machinery and equipment. So you specifically tend to finance those assets independently of, say, the actual farmland operations. On occasion, there would be instances where businesses were looking for additional cash flow. So sometimes that could be for such straightforward reasons as they actually were wanting to purchase inputs maybe in greater bulk capacities because there was opportunity to achieve discounts by buying large quantities in bulk, or there was an opportunity at a certain time of year to get inputs at a lower price. So sometimes it would be due to those reasons. Sometimes for the reason of buying fodder or accumulating that at certain times during the year when it was particularly more fortuitous with market prices. And so those were some of the, I guess, operating reasons. Then we'd see businesses expanding their livestock. That would often consume quite a bit of cash. And on occasion, we also, particularly in agriculture, where we know there is quite a volatility relative to seasonal conditions. Occasionally too, we had to look at funding operating losses to provide additional cash flow to go through another season or for another 12-month period of time. So they were some of the main sort of reasons that we would see people approaching the bank, Sam.
Yeah, so when you say approaching the bank, that's what I would typically and what we would typically think of the place you would borrow money from. But are there any other types of organisations that would lend money to banks? To farms, sorry?
Yeah, well, I mean, it's becoming more and more varied. I guess the banks are probably the traditional and default organisation we think of when we think of borrowing. But now, obviously, machinery dealers, for example, they're far more active in that space, and most will provide finance options when you're looking at purchasing. There's also quite a niche industry around livestock loans. So they tend to be associated with stock and station agents more particularly, and they will provide funding against primarily the livestock itself. And then also we're seeing an emergence more so of private lenders. So they're people that are sort of non-bank related, or they could be organisations that don't operate under an Australian financial services licence. So they're out in the marketplace as well and starting to provide some alternatives to banks as the traditional place that we're used to acquiring finance.
Mm. So those lenders, banks or the other ones you've laid out there, what are the main things that they're looking for when they're assessing applications for a loan?
Yeah, okay, it's a great question. When I was in banking, we used to have a bit of a jargon that would be called the 3 C's of banking. So the 3 C's was basically looking at the character of the person that's borrowing the money, the collateral that was being offered to secure the loan, and then also the cash flow that ultimately would be the source of repayment. And we used to say, sort of as a rule of thumb, you could have 2 of the 3 and probably be okay, but you certainly wouldn't get by with only 1 of the 3. So that was a rule of thumb that they probably won't admit to or speak too much to these days. But basically, they really need to have a great understanding of who's borrowing the funds and whether that ultimately, even if you have a company structure or a trust, which we're not going to go into great detail today about structures, but ultimately there's always a management responsibility. So they're looking at, have those people had experience running that type of business, what their track record is, and they're wanting to know sort of, what their capacity is to be able to manage the business ongoing. If the business is new, then obviously that throws up some additional risks that need to be addressed. If it's very well established, then that's great because there's often a track record that we can refer to. They're also wanting to really understand, well, how will the loan be repaid? So most often that would obviously be from the cash flow generated through the business. So especially with agriculture, they'll have a fairly good understanding of what some of the production metrics are, and they can quite easily sort of validate those and understand what the capacity is to repay. And then finally, and probably do need to acknowledge this, that they will look at, if the loan can't be repaid, how would they actually recover their original loan funds? So, and that's where we get into those discussions about bank security, which we will go into a little bit more detail further on today.
Right. Yeah, great. Okay, that's very interesting. Through that, you mentioned business. We're talking about farm business here. So can you explain to me what, or if there is a difference between, say, a mortgage on a house or a credit card or a personal loan and a business loan?
Yeah, for sure. So I think most people would be familiar with the credit card concept. You can obviously have access to the funds today, and then you'll be required to make a minimum payment, and it's at a fairly high interest rate. So then we roll into home mortgages, and again, probably one of the more straightforward banking products. And in regards to those, long term, generally the bank will provide you a home loan over 30-year term. And that means that then obviously the monthly payments are within the relative affordability of most income earners. When we roll into the business space, the banks generally apply a much shorter term. So you might be looking at 10 to 15 years to repay the funds. And then the second part will be, often the interest rates are slightly higher. So that means the cash flow requirements to repay the loan are generally slightly higher. And there's a different process in terms of how the banks actually review business lending. They take a far more, I suppose, detailed credit assessment, whereas potentially with home loans, it's a little bit more straightforward. And obviously there's a residential property, which is quite easy for them to understand. So they're probably the primary differences.
Yep. Okay, great. And so at the start, you mentioned why farmers borrow money, or a farm business might borrow money. And so there assumingly is an advantage for a farm business to take on debt.
Yeah, what we've seen through some experience there is that obviously if we take on debt today, we might be able to acquire an asset that we couldn't necessarily afford from our cash reserves. And so it brings that asset into the business, and then we can use that to generate additional income. So when managed in the right way, debt can really fuel the growth of a business, and it can help it expand more rapidly, I guess, than if it relied on just retaining its profits at the end of the year and reinvesting those back in the business. So one of the, sorry, Sam?
No, go. Sorry, I was just going to say, well, if it can't be all benefits, is there what are the risks of taking on extra debt?
Yeah, well, and definitely one of the key risks, and especially in primary industries, agriculture, where we're relying on seasonal conditions across a lot of those industries. The volatility of income is really one of the key risks. So poor seasons and consecutive poor seasons can actually lead to a significant amount of cash flow stress. And obviously when there is debt in the business, whoever has provided that debt will have a repayment schedule that they expect you to meet, which is at least interest. So generally what can happen there is debt can create additional cash flow stress in a business, and that is one of the real downsides that it does. The more gearing and leverage is basically higher levels of debt relative to the total assets, and the higher that goes, which I'll discuss those concepts a bit later, basically the more risk you're introducing into your business structure. So that is one point to definitely note. And I guess when we're often planning around budgets and cash flows, we do utilize a lot of averages. So we might utilize production averages, market price averages. Now, obviously, the averages aren't the real world, but they're our best starting point. I guess the main thing I'd note there is when we're working from averages, we don't always know how the run of seasonal conditions will be. We might get 2 very positive seasons in a row. We could get 3 less than average outcomes in a row. So what we always have to sort of keep in mind with debt in a business is that we do have sort of a plan B if things don't work out as we intended.
Yeah, great. And in the same conversation as debt, we often hear the word equity. And I was wondering if you could explain to us what the difference between debt and equity is.
Yeah, so for sure. I guess when we're talking about debt and equity, generally equity is an investment of money in a business and debt is a loan. So equity investments tend to be contributed into the business. There's no set rate of return. A person who contributes equity can expect to receive a share of profit potentially, whereas if you take on debt, there's a very distinct and specified usually rate of interest that will apply, and the party who provided that debt expects you to pay that rate of interest. So that's where debt is expected to be repaid and equity is flexibly, I guess, repaid or returned on based on how the business performs. And that's why generally businesses with higher levels of equity show greater resilience, because they're not committed to external sort of cash flow commitments around debt servicing. So they're probably the key things. If you invest equity in a business, you actually are in some way subjecting that you could lose a portion of that equity if things don't go well. Whereas often with debt, the expectation is that that is repaid, basically the principal plus interest, and there's really not a lot of negotiation that goes on around what the repayments will or will not be. So they're probably the main things that I can think of that sets debt and equity apart.
Right. And last question from me, Jane, but is there any methods that a farm business could use to analyse how much debt they can take on?
Yes, there are benchmarks that we've used as a rule of thumb. I'd probably say with any of those, the proviso is you need to really understand them for your own industry and also your own regional location. We would say with some areas, particularly if I talk from a cropping example, as we get into sort of the lower rainfall zones, you know, they tend to operate on a much lower level of debt compared to their total assets because they require that additional resilience to address the seasonal fluctuations that they might experience. So if I gave you all a rule of thumb based on that proviso, we'd often say if you see something that's exceeding about $1 of debt to each dollar of income, it's probably worth having a look at, that and how that can be addressed, because we tend to find that once that you exceed that level, we'd consider that the gearing or I suppose the debt pressure within the business is starting to get to the higher end.
So Jane, just checking. So Rebecca Campbell just has a question in the chat here around what's a positive equity level that a bank likes.
Yeah, so I can give you some general comments there. We've seen this changing a little bit over time. If I went back maybe 10 or so years ago, we would have said, up to sort of 30% equity, 70% debt, they would accommodate. We've probably seen that drop back quite considerably. With an experienced operator, they might be willing to look at 40% equity and 60% debt. But again, I have to say that can vary significantly from industry to industry and also regionally. And we find that once we get back to about a 50-50, 50% debt, 50% equity, then if you're within that range, we would say it becomes quite a sort of more simple, straightforward process to be able to get loan funds from it or funding from a bank. One of the key reasons I might just speak to at the moment why that is, the banks are very, I suppose, conservative around some of the forecasting and predictions that we utilise with budgeting, particularly in the agri space. So what they're trying to do there is, in all instances, they want to ensure that there is some level of capacity to actually provide support if we do experience those more adverse seasonal conditions. So the last thing they would want is to put someone into a business scenario where the first poor season actually sees them unable to continue on. So that might answer that in part. Did we want to address any of the other chat comments? There's a couple more there.
Yes. Yeah. So Rebecca, just add in if you've got any further questions around that, or if that sort of answered your question. And yeah, we've got we'll head over to John's question. Why are banks so reluctant to lend on rural property even if personal income will easily pay the mortgage? So I think, yeah, you've touched on a bit of that, Jamie, if there was anything else to add.
So that question, without sort of knowing obviously the full circumstances, but they generally, even if personal income will repay, say the loan, they still would be reticent to extend credit beyond sort of that, probably 60% of total value. That tends to be one of the sort of key thresholds that banks just feel uncomfortable to go beyond. And second to that, if it is a rural property that is required to be funded through a business loan, then the repayments might be significantly higher than we would expect to see on a home loan. And so that could have some impacts too on how affordable the debt level is. So happy to take further comments offline. I think I've got my email details at the end of the presentation, so more than happy to sort of talk those through specifically if anyone wanted.
Thanks, Jane. And Rebecca's just added on, is it best to pay down debt at the start or just to pay the interest and use additional funds to spend on the business?
Okay, well, just before I go into that question, because I do have a good slide coming up, I just wondered if you wanted to complete your poll or to run through any of the results of that at all, Sarah?
Yeah, sure. So I can do that. So the poll has closed. I can quickly share the results. So basically around that Question one, how confident are you with the knowledge to set goals? We're sort of sitting around that slightly to moderate with a few either side, and we're only sort of slightly confident around applying for rural financing. So I think that shows that we're in the right meeting. Jane?
Yeah, for sure. Obviously, I can see there's a range of results, and yeah, it looks like I think we'll be able to add quite a bit of value for people on the workshop today who were sort of in that moderately, slightly, or not at all confident about having the required knowledge. And anyone that wasn't so confident about applying for rural financing, I think we can help with some of that as well through today's content.
Awesome. Thanks, Jane.
Okay.
So
I might then, in addressing, I think it's Rebecca's question about paying down debt or keeping the additional cash flow and reinvesting in the business, I might bring up my next slide.
Yeah, and I know we do have a question from Lucy and Sarah as well, but we'll go with Bex first.
Yeah, for sure. Just feel free to call those out to me as we go, Sarah. I'm pretty flexible on just jumping into the questions and answering what people want to know more about. So that's no problem of mine.
That's the idea.
Yeah. Okay, so in answer to your question, Rebecca, I have got this bit of a diagram or graphic around the financial focus of businesses during the different life stages. So if you're starting off in business and it's a new business, not well established, you would probably consider yourself in that emerging or growing phase of the life cycle. What we say about businesses in this phase is that they are very, very cash flow hungry. So basically what they generate in terms of cash flow, they consume because they're always expanding and growing and using that cash flow to be able to invest in additional assets for the business. So in that situation, you might, I suppose, try to balance how much you reduce debt against preserving enough cash flow to actually reinvest and spend on the business. Having said that, I mean, if you do borrow money, the bank may apply to you a repayment schedule, and obviously then that needs to be met as one of the priorities of the business, and you don't have so much flexibility on what you do with the additional cash flow. We then move into a phase of business growth where we start to temper out the actual growth and we start to consolidate. And so at that point in time, the business is still probably not got a lot of spare cash flow or available cash flow. We tend to find through that emerging, growing and consolidating phase that cash flow management takes up quite a significant portion of time of the managers in those businesses. And it's not until we really start to get into that more mature phase that we can consolidate and start to really perhaps reduce debt significantly or reinvest in assets that are outside of the business. So it is pretty challenging for anyone with a business in that emerging or growing or consolidating phase to really consider taking money out of the business to invest in outside assets, which might be off-farm investments, for example. And we don't really see that happening until we get to the mature phase of the life cycle. And then there was also, I think, a comment around succession planning and what happens with loans. And probably where I'd come in to this is the succession planning for a farm business actually often happens in that last phase there, where there's a decision about whether there's renewal and further growth of the business or potentially a division of assets. And often what makes succession planning quite challenging is that there's not enough of an asset pool to, I guess, achieve what everyone wants to do as their aims and objectives. So speaking to the question more specifically, so from Lucy, what happens with existing loans and or new loans with incoming generations? That's really a matter for having, I guess, that conversation with the bank particularly. I've seen this managed in quite a few different ways. So some businesses essentially, for any new generations coming in, they operate quite independently, and any debt that they acquire is their own, might be supported by the primary business, but it would be in their own name. And so they really just roll in and continue on that way. If you became part of an existing business structure, then I guess the point would be that you really do take on some form of that responsibility for the existing loans. In terms of the implications, I'm not sure I totally understand that part of your question, Lucy, so feel free to clarify that. But essentially, if, for instance, one generation is completely stepping away and the next generation is taking over, that's really just something that needs to be addressed with the bank in terms of changes to the management structure. But generally, as long as there's confidence in the ability to continue to run the farm or the operations, there shouldn't be too many problems with that going forward. If there's a more specific question than that, I'm happy to answer it. So I'm just wondering, Sarah, was there any other questions you think we need to address at the moment?
Tom just had a quick one. Are interest-only loans available for farming?
Yeah, excellent question, Tom. In fact, interest-only loans are available for farming enterprises, and I've probably seen that interest-only loans are quite extensively used for farming enterprises. So what that means is that ideally you have no commitment on an annual level to actually reduce the debt. You would ultimately just pay the interest, and that would be by agreement under contract. So it can be annually, quarterly or monthly. And at some point in time, that interest only contract ends, and then it needs to be renegotiated with the bank. So the bank might agree to 2, 3, 4, 5 years interest only. Then the loan contract ends and it needs to be rolled over into something else. So hopefully that's answered that question. I might continue on through the rest of the, I've got a few other comments and principles that I'd like to sort of comment on.
Yeah.
I think we've talked on this briefly. Sorry, did someone have a comment?
I was just wondering about Justin's comment. Did you see that one? Sorry, I just had to pop out for a minute.
Oh, yeah, okay. So Justin, I see in the chat box, mentions they seemingly had a good long-term relationship with the bank, and then a long-term manager with ag experience left, and it was like they had no relationship at all, and we're currently looking to maybe change institutions. And how do we best avoid this situation going forward? It's a really good question from Justin, and it's one that I do hear quite a lot of comment on. Unfortunately, we are a little bit subject to how banks choose to structure themselves. So I know some of the banks have had fairly significant organisational changes, and they have put some of their customers into different types of management arrangements from time to time, around sort of one central call number, and you call someone and you'll get a staff member, but you don't have a dedicated staff member. I know that causes quite a lot of angst, because sometimes you can't get consistency with speaking to one person and often have to repeat yourself time and again. So the one thing that you can do there is always have, I suppose, relationships with 2 financial institutions. And that might be that one of them you do most of your banking with, and you may have sort of your main trading account and maybe a second loan. But then if you're going to go and purchase a piece of equipment, that might be something that you talk to a second bank about and run it through them, so that you have at least a point of contact or relationship with 2 financial organisations and 2 individuals. And then if you find that one doesn't service what you want out of the banking relationship at a point in time, if, for instance, as Justin's mentioned, they lose that long-term manager and then have really no one to talk to, you could revert to your second, I suppose, contact and explore, expanding your relationship with them. So in general, that's what I've found a lot of clients have actually done to avoid that type of situation. They've established relationships with more than one financial institution and at least had a point of contact at a second one so that they were able to talk to someone directly. So hopefully that answers that. And Mark has mentioned, I see there, that an ag finance broker is also a solution, and that's a great point. And I am seeing that they're becoming far more active in the market. So effectively what happens there is that they're like an intermediary between yourself and the bank. So they'll assist with how you interact with the bank, and the benefit there is they're often in their own businesses, so they manage and control what they do, and they are more consistently available to you, and then it's their job to basically deal with the banks, and you don't have to sort of have as much engagement day to day at that level. And Justin's also said that exactly that's something that they did. They actually have used a broker for machinery finance, and brokers are particularly active in that machinery finance space because generally speaking, machinery finance is what we'd consider a standalone transaction. So you can really take it out to any finance provider in the market, and it's quite simple and straightforward for anyone to really finance a piece of equipment for you. Rebecca has also, I might keep going with the questions, Sarah, while they keep flowing through. Is that?
Yeah.
I'm not,
go for
I'm
it.
not making it far through my slide diagrams, but that's okay. We will get there. So Rebecca asks, by taking on more debt and trying to enhance equity within your business, is it positive from a tax point of view? So that's a hard question, Rebecca, to answer just from a generalised perspective. Taxation issues are so specific to individual business structures and what's within that business. So for instance, if a business has got a lot of plant and equipment, for example, or a lot of depreciating assets, they'll be in a different situation to another business that doesn't have, as much scope to utilise depreciation to offset profits. I do hear the comment quite a lot that to pay off debt, I have to pay tax. And so what people are saying there is that obviously that money has to be retained to reduce the debt, and paying off debt is not a tax deductible expense. So as compared to if they go out, and particularly right now with these tax offsets on new machinery and equipment, so what you might hear talked about is accelerated depreciation. So you go out and buy a new piece of equipment, and if it's the total value is under, I think, 150,000, you can essentially expense that through your business, and it's a huge tax deduction. If you paid $150,000 off your debt, you won't achieve that same tax deduction. So that's the main thing I tend to hear about with why people are not so, I suppose, motivated to pay off debt. So they feel like they'll have a tax bill on the other end. But having said that, I still think debt levels need to be really carefully managed, and especially within these types of businesses, if you experience income volatility. So that's one that needs to be balanced and managed, and it also depends on where the business is at in its life cycle. If it needs that cash flow to reinvest, then obviously that's what we would probably prioritise. But if they're in that more mature phase, then maybe debt reduction is a higher priority, and certainly from a succession point of view, to enable that to occur probably with less complications, or the more equity there is, I tend to find the more easily that some of those succession plans can be implemented, just because there's a bigger pool of assets to be able to work with. So then also Dominique has asked, how would you go about getting a loan to buy the family farm off parents for succession planning without having a huge deposit and a new business with not much equity. So this is particularly one that is really a challenge, I find, in that succession planning space. What we might be talking about there is actually buying the property off parents at market value. Now, if that is what we're trying to achieve, there's not really going to be a bank around that would fund us, you know, beyond sort of that 50-60%. And so then it's a matter of how do we finance the rest. So it may be that in terms of that, if the equity levels are okay, generally a bank will look at entertaining the loan based around whether the security is adequate for what they would need. The fact that there's a limited track record for that maybe generation coming in is partly offset by the fact that there is a previous generation which hopefully might support them through that transition. So I wouldn't say a bank would be as concerned with that, but with the limited equity, that's going to be a challenge, and there's just not an easy answer to that question. And second to that, coming into a farming business with very low levels of equity, whether it's from a bank loan or loan from a third party, is a risky proposition. So you really need to consider if that's, you know, something that you would want to pursue. Because if you do experience those sort of adverse seasonal conditions, how would you manage through them? And you've really got to have a good plan around that probably before you sort of proceed down that track. So hopefully that's answered that one. And then Dominique's question, well, following on, Aaron's asking around Dominique's question, what's my experience with vendor finance? And John also speaks to vendor finance. Definitely, I've seen this utilised, and it obviously is where the vendor leaves a proportion of the purchase price in as a loan. It's really important to ensure that we just know what the terms of that vendor finance are, and obviously our ability to fulfil those terms based on what the business enterprise is that we're going to be operating. So it can be used, and if it is family and they're flexible on it, then by all means it's something that possibly should be further explored. If it's a third party who's quite strict on how long they'll leave the equity in, you really need to have a good think about what you would do if you got to the end of the term and you couldn't pay out that vendor finance, or what would happen if you couldn't pay out that vendor finance. So what I'm saying is it's always important to understand the terms of any contract that we're going to go into. And I think I'll be mentioning that a bit more as we go through today's workshop. So far, thanks everyone. Great questions coming through. I'm loving the interaction here. We're going well, Sarah.
We are, yeah.
Okay. Quickly, Jordan's asked my experience on lease to buy options. I might cover that in a bit more detail as we go through, but definitely we're seeing that that's becoming, more and more prevalent in agriculture. Lease to buy on equipment has always been quite a big part of earth moving industry, and now we're starting to see it come into agricultural equipment as well. So I will talk about that in a bit more detail later. So just to wrap up, I guess, in terms of the debt to equity that you've been looking at, essentially total assets in any business is made up of the debt plus the equity. So what banks are always looking at is what proportion of your total assets is funded by debt versus what portion is funded by equity. Okay, moving on. One thing that I've touched on today, and probably one that I'd really encourage people to take a bit of their own time to investigate further and understand more fully, is the working capital aspect. So working capital is basically the money or assets in the business that can be available at fairly short notice to pay for the operating expenses or the other debt commitments that the business has. So it's really the cycle of actual cash through the business. And this graphic just tries to sort of outline what constitutes working capital. So the working capital in a business is generally described as its current assets less its current liabilities. And I don't really want to get into too many sort of technical accounting terms today. We can probably spend a whole 2 hours on those alone. So current assets are really things that we can quite quickly turn into cash. So cash is a current asset. Inventory, they do talk about property here, but it's probably more so the ability to use property as a source of cash in a business. And then your liabilities, current liabilities, are your bills that really need to be paid in the short term. So, you know, wages, ignore rent, that might be lease on land, for example, utilities, input bills for inputs, fodder, feed, those types of things. And so the more current assets you have compared to current liabilities, the more working capital you have in the business. And that's really what meets your day-to-day expenses. And so that's part of the cash flow, I suppose, equation in a business. And I think my next graphic will tell you a bit more about that. So this graphic, we do a lot of this work with clients to construct their budgets and cash flows. And why we do this is if you are running a business where you have long cycles between when income is received and you have to pay substantial costs in the business to generate that income, it's really important to understand if we're starting back in sort of March, do we have enough cash available in the business to see us through, if this is, for instance, a cropping enterprise, right through until, say, November, when we see the bulk of our income come in. And it's important, this is where I sort of talk about those adverse seasons. So seasons where we've spent all this money maybe on putting a crop in and getting it to a point where we are trying to achieve a harvest, but then something goes awry and we don't actually receive as much income as we had anticipated. So in terms of this cash flow management, this is just a tool to ensure that you do have sufficient money to run your business. And if we looked at, for instance, a dairy example, I mean, obviously they have peak lactation times when the actual monthly income is significantly more than it might be when the cows are dried off, for instance. And so they need to understand their sort of cycles through that monthly cycle to ensure that they are accumulating enough cash to get them through the months when maybe the income isn't as high as it can be in other months. So if you are looking at managing and operating a farm business, I would really encourage you to take time to understand a bit more about budgeting and cash flow, because speaking from my banking experience, this can be one of the key areas that people run into some challenges with when they're new, I suppose, in their management experience. And also when the business is quite new, as we saw earlier, it maybe doesn't have as much capacity to store reserves of cash. So everything's a little bit more tight in terms of money in and money out. And so it does need to be quite well managed and monitored throughout the year. So that's probably comments on cash flow. If anyone had any queries on that, the graph here basically shows a business that would have $150,000 overdraft, and then based on their monthly expenses, we see them get right through to October, where their actual bank account balance would be estimated to be about, say, $130,000 in overdraft, and then they obviously start receiving income after that period, and we see the actual balance of the bank account revert back into credit and around $45,000 credit, and then we just see the rest of the effects of as grain is sold or hay is sold and money comes in.
Thanks, Jane. We've got some resources that we can share after this workshop with people on how to do some of those through our Young Farmer Business Network. So yeah, if that's
Excellent.
helpful for people, we can provide that.
Yeah, particularly dealing with banks, they don't really like to have surprises when it comes to cash flows. So it's very hard right now to get a quick response from a bank. So if you were going to need additional cash flow support, maybe an overdraft increase, at the moment you probably need to be allowing at least 3 to 4 months lead time with a bank to get an overdraft increase. So of course, if you realise, oh, we're going to be really tight next month and we don't have enough reserves to pay our expenses next month, you're going to find the bank's not going to be able to respond fast enough at the moment to actually assist with getting an overdraft increase in place. And I know this from dealing with banks for multiple clients. If we know that they're going to have some sort of borrowing requirement, we're really looking 3 to 4 months ahead from where it's going to be needed to get an application into the bank. So that's probably another tip for anyone today. Allow plenty of lead time if you want to sort of approach a bank for a loan or lending. I think Jordan's asked what determines the overdraft capacity of new businesses. So that is another very good question. And generally speaking, I would say it's around what the requirements are going to be for whatever the cash flow cycle is for your particular business or industry. So I might keep scrolling through because I do speak about that in a little bit more detail.
Yeah, cool. Just so you know, Jan, we've got about 30 minutes to go.
Yeah. Tracking that, I'll try and whip through these finance.
No, you're good. I think, yeah, that's great. Thank you.
Yeah, we've had great questions. So I feel like we've covered some of the later stuff earlier, but that's excellent. So in terms of finance terms, I probably won't go through these in great detail, but hopefully if you're not sort of familiar with these, we'll quickly roll through them. If you hear someone talk about a vendor, that's whoever's selling the asset. The purchaser is the person buying the asset. The lender obviously provides funds under a loan contract. A borrower is the person that has use of the funds under a loan contract. You might hear people speak about default on contracts. That's basically failing to adhere to the terms of the contract. Guarantors are something that you may or may not have sort of heard a little bit about, and particularly if you are in a position where you have family that are willing to assist you in transitioning into the business. Guarantors essentially provide an undertaking to repay the debt in the event that the borrower defaults. And so there are quite a number of instances where guarantees are utilised, I know, especially in agriculture, where younger generations are transitioning into becoming part of a farming enterprise. Interest is the charge applied for borrowing the funds. So generally that's charged to your bank account. The interest rate is the rate of charge that they apply to the funds. So right now you probably heard interest rates of around 2 to 3 to 4%. And historically that's really, really low. And I must say, when I sort of started in banking, I think the average home loan was about 8%. So one other thing I'd encourage you to do if you are looking at your own business dealings, and there is debt involved, consider what would happen if interest rates did increase, and just budget that in sometimes that interest rates might increase, and see what that would do to your total business cash flow or budget. Okay, some other terms continued. We've touched on security. So security, when you're talking to a bank, you'll hear them mention this term quite frequently. What's the security for the loan? And basically, this is the assets which could be sold by the lender to repay the debt in the event of default. So in a simple home loan scenario, they'll take a mortgage over the residential property, and at the end of the day, if you were to default and not pay the loan back the bank does have the right then to take that asset and sell it to achieve clearance on the debt. Then we have a mortgage, and that's basically, a mortgage is the document that allows the lender to sell assets in the event of a default. If you're offering property as security as part of any loan, you will be asked generally to sign a mortgage. So when you see that document, mortgage of land, you can understand that basically that's you signing over to the bank that in the event that you don't repay the loan, and it would go through a fairly lengthy process to get to this point, but I'm just jumping ahead. They could possibly have the right to take over the property and sell it on your behalf. Directors' guarantees, you'll often hear these talked about, particularly if you are providing, it's an undertaking provided by the director of companies when they borrow. So what it means is that you might have a company established, and it might be ABC Proprietary Limited, and you're the director. If you acquire finance for ABC, maybe by, let's say we are buying a truck and trailer, the bank would likely ask you to provide a director's guarantee, which means in the event that the company defaults, you're personally liable. So if you start getting into a structure where you're using a company, which is a proprietary limited organisation, you will start to become familiar with that term of director's guarantee. And just recall that every time you sign that, you're effectively becoming personally liable for the debt involved. So then we move on, debt to equity ratios. So they're the percentage of debt to total assets. And I think we've spoken about that, and quite a few people have asked questions on that in the chat box about not, and I have heard a lot, with banks, and in my time with the bank, finding the equity is often a challenge. So we're going to talk on further some ways in which you can get started, which don't require sort of that, having that amount of equity to get going in a business structure. And loan to valuation ratio, from a bank's perspective, they talk that a lot, and that's the percentage of debt to total value of the loan security. So that one more so refers specifically only to the security that they have, which supports the loan, as opposed to debt to equity looks at the whole bundle of debt and assets in a business. I'm seeing a question there from Jude Hicks on opinion of having FMDs locked up or use them to pay off debt if you have a manageable tax situation. That one, I'd really have to say, I can't, it's really hard to answer that question specifically without sort of having a very detailed look at what the situation is there in regards to the tax position. So that's really a specific question for an accountant. But I guess the main thing I would say is it's worth asking the question and getting the accountant to give an opinion about how that could potentially be managed. So it's just that you'd want to understand what sort of taxation impact that would have. I've moved on to another. Sorry, Sarah.
You're right. I was just going to say we do have some more information on farm management deposits coming up through our business network as well. So that might be another spot to for those that are interested in that topic. Go back to that. Yep. Thanks.
I've just also got here a quick graphic around loan interest calculations over time. So the point of this was if you borrow basically a principal amount of $1 million and can repay that over 5 years, you'll pay about $107,000 total interest. If we look further down then, and perhaps we took the $1 million and it takes us and we hold the debt for 20 years. So we're assuming that that $1 million just doesn't get reduced at all over the period of time. The total interest paid would be $407,000. So what we're doing here is just trying to give you an idea of relativity on sort of time and interest, even though 3.5 is, you know, quite low, and we would say manageable at this point. It's still over a course of time will sort of compound. So that's just a quick graphic to show that effect of time and interest. So that's not considering compounding, it's just the annual charge. So not a compound interest charge. I also was just broadly going to talk through some finance options, but basically there you've got your overdrafts, your term loans, equipment finance, stock loans, touched on vendor loans already today. We've also got private loans, which I've just touched on briefly, provided by non-bank lenders, and then you'll also find things like seasonal crop finance, which you can use to pay for cropping inputs before they're harvested or sold. And there's a few different types of finance that will fund specific assets. Stock loans obviously being used on livestock. Okay, I think, Rebecca, I can see your question there about being the next generation wanted to purchase land next door. I might come back to that. I'll just quickly go through this banking checklist and then into some of the business options or opportunities that there could, you know, people could consider, and I'll cover that as part of it as well. So when you are dealing with a bank on a loan application, you basically can choose either to go direct to the bank, or as we have spoken about, you could use a broker. And there are quite a few brokers around now who specifically deal with agriculture and agribusiness loans. It's often a really good idea to find one of these by word of mouth, so that you can speak to someone who's, you know, had an experience with them and recommends them. That's often a really good recommendation. Other things that are going to happen, so once you make the approach to the bank, they are going to do credit checks. So when they do credit checks, they'll basically be able to see what other loans you might already have outstanding, and they'll also be able to see what your repayment history has been like on credit cards and other loans. So it is really important to make sure that whenever we have a loan or a credit card, that we do keep up to date with payments, because they can see all that information when they do those checks. Then if you have tax returns or financial statements, it's really a good idea to keep those current, up to date. The bank is going to want to see those. And as part of that, you also need to ensure that your taxation obligations are being met in a timely way. So that includes being up to date on any GST returns. The bank might ask you, more than likely will ask you, if you've been in an established business, they'll want to see your ATO portals. And what they can see there is how timely you are with submitting and paying your taxation obligations. Banks place quite a lot of value on those ATO portals, because what they will often find is that when businesses are starting to come under cash flow stress, that's one of the first things that starts to suffer. People are late submitting their tax returns, or they're late submitting their BAS, or payments are not made, or there's liability sitting with the ATO. So they will check that. They probably would want to see your cash flow budgets, which is an annual plan of income expenses over 12 months. And they want to know how you've come up with those income estimates and expenses. So that's particularly cash flow and budgets. Like, that's a part of work that we spend a lot of time helping and assisting clients to put those together. For some businesses, it can be really quite complex, and they are important documents to sort of show to a bank what we think will happen over the next 12 months. And we're finding that it'll be very challenging to get a loan application for a rural business loan through a bank without having some sort of cash flow or budget associated with it. The statement of position will really just tell them all about your assets, liabilities at current value, and that's where they'll understand a bit more about your complete debt and equity position. A business plan is always a really great idea. So that'll give them details about the farm business, the people involved, what you're trying to achieve, and particularly around the succession piece, it can often outline how that's anticipated to happen. So is someone going to come in and take over the business? Is it going to need to be distributed amongst family members? So that can be included in there in terms of how the business will continue on beyond maybe the current generation involved. And then working capital requirements, this is what I've come back to. In any situation, the bank's going to want to be able to have some understanding that you have enough cash to basically run through an operating cycle. So, or that you know that you have basically enough reserves to meet your expenses based on what your income might be. They don't really like surprises when it comes to that working capital piece. What that can sometimes tell them is that you don't totally understand the business unless you've got a very good reason, something totally unexpected happened. They don't sort of appreciate, or they get quite concerned if you're coming to them for overdraft increases and there's not a particularly clear reason as to why that's happening. So I just flag that. And then I think from there, Sarah, we're moving on into some farm business initiatives. So this is probably around, you know, what are the opportunities to become involved in a business or to grow some equity, because it can be hard to just have it available to go out and buy a parcel of land, particularly when the banks want to see, you know, up to, as we talked before, 40 to 50% of your own money in the mix. So I might just touch on Rebecca's question. So from here, Rebecca's asked, being the next generation and wanting to purchase land next door, not having enough of a deposit, what would be the best plan of action? Approach the bank or main family business? So probably in answer to that, Rebecca, I would say that if you didn't have a big enough cash deposit, then ideally support from the main family business would be ideal. Now they might be able to support that via the guarantee style process that I spoke about before. So that's where then they are basically providing that guarantee to the bank to say that if there was any issue, we obviously would address that. So what that does is it gives the bank a greater level of confidence to be able to lend additional money. And then the other thing that they can do is bring in security owned by a third party, and that person guarantees it. So in this case, how it would technically work, and I'm just suggesting that this is a technical way, and then obviously you'd need to have your own way of approaching it, I guess, with the family, is that if there's some existing security or existing land owned by mum and dad and there's no debt, mum and dad might offer that to the bank as security for a loan to buy the block next door, so that we can borrow all of the money involved in the block next door. And then their guarantee says that if there's any issues with that loan, they would obviously step in and assist, or the bank could sell their security to clear the loan. So guarantees are one thing that has been used quite a lot in my banking experience, which helps with that generational transfer. It has tightened up a lot now in terms of people providing guarantees. You have to be able to demonstrate that there's a commercial benefit to the party that's providing the guarantee. And I know that sounds probably a little bit complex, but basically what that means is if you're all farming together and the farming business is going to maybe operate the land as part of the broader business structure, then obviously the business itself will benefit, and so therefore mum and dad will benefit because it increases the land holding available to the main entity to farm. So there's probably a first step would be there, you know, to maybe approach the bank and just speak about it theoretically and ask, you know, in what ways they could see that it could be worked around. I know that I did do quite a bit of that with clients. So if they sat down and explained to me what it was they were trying to achieve, we'd look at all the possible scenarios and try and outline one that worked really well for everyone involved. So certainly, Rebecca, if you had any specific questions on that, I'm happy to answer those via email. And Mark mentions, Mark, you're quite right, Regional Investment Corporation have an Agri Starter loan coming up, and I have got some details on that further on. At the moment, there's not a lot of information about the Agri Starter loan, so I think it launches in January 2021, and it's definitely an opportunity to have a look and see what their provisions are, so whether they have some different provisions around security. I can't say too much on it because they haven't actually launched out the full details of the product, but it's certainly one to keep track of and keep a lookout for. So around that, probably some of the other options to get involved in farming business that I've seen utilised really well. I have seen some people take profit share arrangements, so they'll provide their labour for a share of income or profit. They don't need to contribute much else, so that's a really low cost way of trying to accumulate a little bit more return for effort. Share farming has always been a big one, so you provide assets and labour for a share of income. That usually requires, depending on which industry you're in, some of the assets you will have had to accumulate over time. Leasing land is another option because obviously as long as you can take on that annual lease payment, you don't really need to contribute an amount of cash up front often. Providing contracting services is another one. I've seen that done very successfully where people have actually built up quite big businesses starting from one piece of equipment and then moving on. And there's agistment, which, you know, is where you can actually start accumulating livestock and agist it on someone else's property. So you pay them just on a per head basis of what's been agisted over a certain period of time. So there's some of the really intriguing, sort of interesting things I've seen. Other than that too, consider if you can afford a smaller land holding, then it's really about how you utilise that land holding and what you do on it to try and generate the best returns possible. So I've seen some things like mushroom farms operated on quite small land holding. I've also seen herb farming, so people growing herbs as part of a cooperative, and they didn't actually require a huge amount of land because that's quite an intense sort of crop. There's also often other intensive industries that could be on a smaller land holding. And they're probably some of the things that I would suggest, along with if you're wanting to be involved in an industry that's particularly got a lot of plant and equipment, you can start to look at accumulating that without potentially having a land holding. If you can get contracts with local farmers to do their work, the banks actually like sort of contracts in place, and then you can look at equipment finance to help finance some of the equipment you might need. One of the interesting aspects is that we've had a lot of comments today about the equity to buy land. Often, if you can evidence to a bank that you can afford to meet the repayments on a piece of equipment, you actually don't need to put any equity into that purchase. So that can sometimes be another way I've seen people build up asset bases of plant and equipment and using those to start their own contracting business. So I guess probably that's some of the main ways I've seen people initiate business. I think the key thing is, if you can't come up with a large amount of money to put into maybe a land purchase, then you've got to look at some alternate smaller ways and different avenues to get involved in agriculture. And I have seen that done quite successfully through building up contracting fleets of equipment, or through building up livestock over time, and just reinvesting the money as the cycles of their livestock trading have run. So probably that's my main comments. I don't think we've had too many more questions at the moment. Sarah, is there anything else that you think I haven't quite covered off, or a last chance for anyone to tap us through a question on the Zoom?
Sure, yeah, go for it, guys. But look, I think that's pretty well addressed all the main content for today. There's still a couple of slides to go in terms of other resources and follow up. But yeah, I'm really, I guess, guided by you guys as to, yeah, more questions in the chat. We are going to launch a quick poll just to see how everyone's found it before we wrap up. But I guess, yeah, this slide here is just to encourage you to join us, check out our Facebook group, visit our website. It does have some information on budgeting and so forth that Jay and you mentioned. And yeah, there's some other young farmer support here. But what I might do is just launch this second poll. This is so that we can find out a little bit more about how you guys found the workshop, so that we can either have another go at this another time. So we'd like to know, how did you find out about today's workshop? So Facebook was one way we promote it. Newspapers picked it up. I did do a radio interview. I'd be really interested to know if anybody heard that. I certainly haven't, but yeah, interested to know if that worked. We'd like to know, you know, how's this information helped you? Are you any more confident now about applying for rural finance? Just how satisfied were you with this workshop? And would you recommend this to other young farmers? And if so, that's great, because we can do more down the track. So yeah, if you haven't already, check out our Facebook group. And there's, I think on the next slide, Jane, there's some more other resources. So yeah, you mentioned the Regional Investment Corporation's Agri Starter Loan. So I guess it's about yeah, having a look there. And there's some other things that you've mentioned. And also just, yeah, check in with your local rural financial counselling service. They are there to help you as well. So feel free to contact them. But yeah, everyone's doing a good job with the poll, so please keep going. You need to answer all 5 questions and then submit them. So yeah, so if anyone has any more questions, please. Oh yeah, good idea. Yep, so we're popping those links into the chat as we go. So yeah, follow those along. Oh, Lucy has asked my favorite question, Jane. What is the definition of a young farmer? Oh, you've I think it's the most asked question that I have, and I've got my answer, Jane. But did you want to what's your one?
Well, it depends what you're reading at any given time, I think, because for instance, I just did put up a link in Victoria. There are some stamp duty exemptions on farming land, but in that regard, you have to be 35 years or younger. So that's a young farmer from the State Revenue Office's perspective. I've sort of heard others up to 40 and younger. So Sarah, what's your view?
Yeah, look, that's I think you're spot on there, Jane. But look, really, in terms of our young farmer program, we are all about helping anyone that's new to farming and managing a farm business. And we know that it's, you know, you may not be in a position to be making those management decisions until a bit later in life, as parents can take that succession process can take quite a long time. So you might have gone off and be doing another career. And I think we've got, there was someone on the line that mentioned that they're a civil engineer turning farmer. So, you know, Tom, you're a classic example of our young farmer audience. So you've gone off, you've done something else, and now it's back to farming. So yeah, I don't think we can put an age limit, and we certainly wouldn't be checking your ID if we were to be doing this face to face.
No, I think all welcome, but yeah, some of those, the agri starter loan is definitely something that everyone should just keep an eye on or track of, because we don't really know much about it at this point, and Regional Investment Corporation is not, well, they sort of sit right outside that traditional bank path or avenue. And so it's going to be very interesting to see what they produce as their agri starter product, because it could be quite advantageous for especially some people here who've mentioned if they're struggling on that equity piece, because Regional Investment Corporation may have a bit more of a generous attitude towards that, but we just have to wait and see until it's launched.
Fantastic. Thanks, Jane. So look, I think 30 out of the 34 people that are still on the line have voted. So if there's anyone else with have a quick go, and then we can end that poll. And I can quickly share the results. But yeah, look, generally, actually what's interesting, and I might just get anyone that's still on the line, is around how you heard about today's workshop. So 60% of people heard it from another way. So if you clicked on other, I would be really interested to know how you found out about today. So look, I'm just going to end that poll now and hopefully share that with you, because it's interesting to see. So yeah, if you clicked the AgVic website, email, good one. So generally we've seen a bit of shift in knowledge around finance, Jane, so that's good news. Confidence somewhat better, so another good news story there. Everyone's pretty satisfied with either, you know, satisfied or very satisfied. A few which are probably sitting on the fence, that's okay, and everyone would recommend this to another young farmer. So I think that's that is all good news. And look, it's coming up to 2 o'clock. So Jane, thank you so much for coming along today and sharing your wisdom with us all. I think, you know, it's been great to have the opportunity to ask questions because, you know, that's what we've got a question, we want to know the answer. So you've done a really great job at answering those questions on the spot. I really appreciate that. And Sam,
thanks all for having me. And as I said, happy if anyone, I think we've got our contact points on the line there. Yeah, look, if anyone just had something they hadn't wanted to flag in the chat, feel free to shoot me a quick note, and as much as I can, I'll see how I can help.
Yeah, fantastic. And thanks, Sam, for your bit at the start. Feel free to contact Sam if you want to get involved in our Livestock Farm Monitor program. And also a big thanks to Sarah Brown and Pippa, who have been sitting in the background but helping make sure that this technology is all ticking along. So big thank you to you guys as well. And yeah, really looking forward to seeing you guys at more of our events in the future. So yeah, thanks so much. Great job.